Good afternoon, everyone. It's 2 o'clock Central European time, and I'm very pleased to welcome you all to today's DAC6 webinar. I'm sharing my screen with the presentation. I hope you can all see it. If you cannot see it, please write in the chat box. What we will do today, we will cover practical examples that will hopefully help you to perform a detailed analysis of the cross-border arrangements in your organizations. So thank you very much for taking the time to join us today. And I hope we will have a productive session. So let me start with the introduction. Yes, so Paul and I have delivered a number of webinars already, and some of you know us by now. For those who are new to these sessions, I'm Anna Szkudlarek, and together with Paul Millen, we founded BlueBridge to help businesses affected by DAC6 meet reporting requirements in a very straightforward and uncomplicated manner. So we both have an extensive knowledge and experience in advising clients in regulatory matters and successfully producing regulatory reports. What do we do at BlueBridge? We deliver peace of mind and freedom from DAC6 through our 3 services. It's a report production, reportability analysis, and liability relief. So we start from simple conversion of the reportable data into an XML for you. We also do the whole analysis of the arrangement in order to qualify it as a reportable or non-reportable arrangement, to the extent that we can even take over the responsibility for reporting from intermediaries. Of course, if we get involved in the transaction early in the stage. So let's go through the housekeeping points before I hand over to Paul to deliver the webinar to you. So the webinar is scheduled for 1 hour today, and at the end we allocated time for you to ask questions. If you, however, want to ask questions during the presentation, please ask them by using the chat function. We have the chat opened, and we can always take the questions as they come along. I'll ask you to remain muted if you can, because it really helps to reduce background distractions. We are also recording this webinar, and a copy of the slides together with the recording will be made available to you and to those who could not attend the session today. So today, Paul will walk you through 3 very comprehensive but interesting DAC6 scenarios, which are very specific to the fiduciary industry. These examples highlight key DAC6 concepts, how you can apply DAC6 hallmarks, especially in the fiduciary business, and the very interesting analytical areas of DAC6. So please welcome Paul, and I wish you a very productive session. Thank you.
Thank you, Anna, and thank you everyone for joining us today. Good afternoon. To those of our attendees who were able to join last month, this is part 2 of the thematic webinar on the effect of DAC6 on fiduciaries. For those of you who were unable to join us, we generally covered the following 3 topics. First, how does DAC6 generally capture trustees and other fiduciaries, and how does it exclude them? So we looked at the 2 definitions of intermediaries under DAC6, how those apply to fiduciaries, how what we refer to as the ignorance defense is available, but probably not so applicable in the fiduciary sphere. And then we looked at 2 subtopics, the role of the legal professional privilege and also the consequences for intermediaries involved in reportable transactions who are not themselves EU-based intermediaries. And then we explained how in those situations, it's possible for the reporting responsibility under DAC6 to flow all the way down to what's known as the relevant taxpayer, but in more common language, it means our clients, your clients, my clients, most of the intermediaries' clients. So that was the first topic we covered. Then we looked at the types of common fiduciary activities that may necessitate DAC6 reporting and why. So you have a set of hallmarks, which are attributes that the EU has deemed to be indicative of aggressive tax planning, and where these hallmarks are met, sometimes in conjunction with a tax benefits test, then a cross-border arrangement is converted into a reportable cross-border arrangement. And several of these hallmarks are very commonplace in the fiduciary industry and will be at the forefront of most fiduciaries' minds when they think of DAC6 hallmarks. But there's another set beyond the standard that we refer to as the exotic ones. And these you would not think would necessarily come into play in the private wealth management sphere. They seem to be more corporate-based DAC6 hallmarks. But as we discussed last week, and as we'll go into a bit today, these hallmarks can come into play, can be working in the background of a private wealth management structure, especially where the family business, the operating company, the source of the wealth is contained within the same wealth management structure. Then the final topic we looked at last week is the information that fiduciaries who do need to report would need to report on their clients under DAC6. Now, the reason we have a part 2 today is because part 1 was long enough and we didn't want to do a full 2-hour webinar. So we decided to chop it into 2 separate sections, the overview theoretical section, which we did in January, and then today's webinar, which will be a series of concrete examples. As Anna mentioned, we have 3 specific examples designed to highlight key concepts under DAC6. The application of the DAC6 hallmarks to the activities of fiduciaries. And then we'll talk a little bit about some of the underdeveloped analytical areas of DAC6 with the final hallmark. If I could ask everyone to make sure they're on mute, that would be very appreciated. I can hear some background noise. Thanks. Okay, so let's move forward. And oopsie. Sorry, I jumped ahead a bunch. Okay. So here's a brief overview of the 3 examples, 3 concrete illustrative examples that we'll be introducing and discussing with you today. And I'll talk about a little bit about, provide a brief description of the scenario, and then which of the DAC6 concepts and or hallmarks we'll be looking to explore with that particular scenario. So in the first scenario, we have a trust. We have an EU beneficial owner of that trust, and the trust holds a portfolio of marketable securities with a bank and converts those marketable securities into the same derivative contracts. So derivative contracts that reference the underlying marketable securities. And this simple transaction yields a series of concepts to explore under DAC6, including the definition of cross-border, of what makes something a cross-border arrangement, the definition of an intermediary, the consequences of no EU nexus for any intermediaries and how that affects the relevant taxpayers, the clients, as I mentioned before, and then the role of legal professional privilege, its scope, and what the implications of an intermediary invoking legal professional privilege could mean. In scenario 2, we have a very common private wealth management structure featuring trust underlying companies and a custodial account holding a portfolio of marketable securities. And this will be talking about the setup of these structures and how the setup of these structures implicates an array of DAC6 hallmarks, including A3, standardized documentation, B2, income conversion, and the 2D hallmarks, which derive from the OECD's mandatory disclosure rules and talk about CRS avoidance and opaque structures. And then we'll briefly touch upon the concept of a marketable arrangement, what that means and what that entails. Then finally, for illustrative example number 3, we'll look at a single family office structure. And here we're going to try and explore some of these exotic hallmarks I mentioned before. So they hold assets and they have various types of investment portfolios. They have an operating business, and it's all under a single umbrella structure with a trust on top and the family members as beneficiaries and settlers of the trust. And using this scenario, we're going to explore the notion of an associated enterprise, a term of art under DAC6. And then again, 3 of the more exotic hallmarks, at least as relates to private wealth management, E3, which is one of the transfer pricing hallmarks, and then C1A and C1B little I. And here we're looking at payments where one of the parties, payments between 2 associated enterprises, where one of the parties is in a very low tax jurisdiction or has no actual tax residence. So those are the concepts and the scenarios that we'll be exploring together over the next 45 minutes or so. Before we dive into the details, anyone have any instant questions or anything that needs further clarification? I see no messages, so let's barnstorm ahead. So, illustrative example 1, you see on your screen in front of you. And as I mentioned in my brief summary, we have a French settlor beneficiary of a trust. Trustee is in Hong Kong. The trust holds in time 0, the scenario on the left, pre-transaction, pre-arrangement. The trust holds a bunch of European securities, marketable securities, as designated by the euro sign and the stock market graph. And these are held with a custodial account at a Swiss bank. And then at time 1, a transaction takes place. And that transaction is selling those securities and replacing them with derivative contracts. These are equity derivative contracts, and they reference the same marketable securities that were previously held in the custodial account. So from an economic standpoint, the purpose here is that there's very little change in the economic status of the assets. It's just other factors will come into play as we'll go into. However, other than that, the structure remains exactly the same in T1. The settlor beneficiary remains French. The trustee remains Hong Kong. And we have a Swiss bank there, and we'll discuss a little bit about what role the Swiss bank may or may not have played in this scenario. Okay, so the first concept we're going to dive into is what makes something a cross-border arrangement. Now, as I mentioned on the last webinar and virtually every webinar we've done, I think the term arrangement is undefined in DAC6, just arrangement, not cross-border, undefined in DAC6. Certain guidance notes have taken a stab at it, defining it as a scheme, transaction, negotiate. I mean, the summary is that arrangement is such a broad or undefined topic that you should not focus on arrangement when determining whether something is reportable, because very few, if anything, will ever be disqualified because it doesn't count as an arrangement. But the term cross-border does have a definition and has a kind of a more detailed one than you might expect. And for a arrangement to be cross-border, it has 2 criteria. 1, it must concern either more than one member state or an EU member state and a third country. So there must be at least 2 jurisdictions involved, one of which, at a minimum, must be an EU member state. And here the question is, well, what does concern mean? And let's talk about this first criterion before we go in there. So in this example, we have euro-denominated European securities. Does that mean it concerns the EU? And the answer is no, it doesn't. It has to be for an arrangement to concern multiple jurisdictions, the jurisdictions themselves must be of some material relevance to the arrangement. And typically what they're looking for, if you take apart all of the exceptions, they're looking for anything that would have a tax consequence in that jurisdiction or would have a CRS consequence, if not a direct tax consequence. So if you see that, then you usually can say that the concerning criterion is met. And here we can imagine, of course, the CRS issue comes into play, but there's also potential tax consequences because the settler beneficiary of these trusts is an EU resident person. So I think it's comfortable to say that the concerns criterion is satisfied. Now, the second criterion for an arrangement to qualify as a cross-border arrangement is that one of the following conditions must be met. Not all the participants are resident in the same jurisdiction. One or more participant is simultaneously resident in more than one jurisdiction. One of the participants carries on a business in another jurisdiction through a permanent establishment. One of the other participants in the arrangement carries on an activity in another jurisdiction. Those are the four main ones. And you could say those could apply here, except participants are only the persons who are actively taking part in the arrangement. So here, of course, we have the Hong Kong trustees and the Swiss banks at a minimum that would qualify here. And the final criterion is certainly applicable here, and they bring back in CRS. And it feels a little bit tacked on, especially when you consider that CRS plays such a determinative role in so many other aspects of DAC6 reporting. But if it's possible that the arrangement has an impact on CRS reporting, then that will also meet this particular criteria. So in this scenario, we have clearly we meet the cross-border arrangement qualification. If the trustees were Swiss, we might have a slightly different scenario there. Then we wouldn't necessarily have the cross-border because the active participants, because of course the settlor beneficiary is not an active participant in this arrangement. He's a party to it, or she is a party to it and a beneficiary of the arrangement, but not an active participant as defined under DAC6. So if the trustees were Swiss, we might have a very different scenario here, except for the fact, as we'll get into, the CRS element will bring all of these activities into DAC6 potentially. So if we look at this, do we have any EU intermediaries in this setup? Well, based on the definition of intermediary, I think it's almost certain that the Hong Kong trustees qualify as intermediaries. But what about the banks? Well, banks, they fit the definition of a service provider. They are providing relevant services to make this arrangement work. But as we've seen, a lot of guidance notes have carved out an exception for banks, which basically allows banks not to qualify as intermediaries where their role is purely processing payments. So even if the bank would be aware, should be aware, that as they transfer these assets to some other bank where they may not be reported, there's a CRS consequence. The bank is no longer necessarily going to do CRS reporting on this account or in a different way. The bank is excused. It's got a carve-out exemption for its payment functions. So let's explore this topic a little further. I mentioned at the beginning that we have another Swiss bank in T1. Now, these are over-the-counter derivative contracts, so they're not necessarily going to be held in a custodial account. So that bank is not custodizing these assets. Is the bank issuing the derivative contract? Would that make the bank into an intermediary? Well, it could be, but it depends on how those activities are linked together. If the bank and if it's the same entity and they're working together to persuade clients of the bank to buy products from the same bank, then you could see a connection there. But at the same time, certain banks have different departments, and one department will create equity-based derivatives, and they'll just make them available on the internal bank store for bank clients. And the bank client can say, I'll take A, D, and F. And it's hard to say that the two different parts of the bank are working together in a way that it amounts to qualification as an intermediary. So there, I think we're at a borderline. Where we definitely would cross the borderline is if the bank played any advisory role in suggesting to the client that he or she purchase these derivative contracts in place in lieu of the securities they currently hold. Then the bank is playing an advisory role and would clearly qualify as an intermediary. But as you can see, it's not always straightforward exactly who's going to qualify as an intermediary. And of course, in this case, the answer will be none. The bank, no matter what it does, will not be an EU intermediary because it's a Swiss bank. So as we currently have it set up, we do not have any EU intermediaries in this structure. Now, what does that mean? That means that to the extent this is a reportable cross-border arrangement, the reporting duty doesn't fall on an intermediary. There's no intermediary subject to EU member state regulations and laws present in this scenario. Consequences of that are DAC6 will find someone who will have a reporting responsibility who is subject to EU laws and regulations. And of course, in this scenario, that person is the French client, the French settler beneficiary trust. So this
meu amor.
Someone's
Onde tá, Paulo?
with their child. Oh yeah. Where's the mute? Okay. Where's the mute function? It's not showing up on this. Sorry, everyone. 1 second. Okay, got it. Sorry, back in business. Thanks, everyone, for your patience. So as this is a CRS avoidance arrangement because the assets that were held in the bank in T0 were held in a reportable form, but it's not these derivative contracts that are OTC. These are a non-reportable financial asset because they're not held in a reportable form. So the reporting that's being done by the Swiss bank in time 0 is no longer being done by the Swiss bank or anyone else in time 1. And as mentioned, there would be no commercial purpose for converting these securities into derivative contracts as the economic situation is identical. And therefore, it's very straightforward, clean-cut case of CRS avoidance in my view. It's designed to be. The hallmarks are not what we're looking at here. So we have now a reportable cross-border arrangement, but no EU intermediaries to report on it. And the consequences of that are that the French relevant taxpayer is burdened with a reporting duty for this particular transaction. Now let's change up the facts a little bit to make it more interesting. What if this Hong Kong trustee was a member of the UK bar? Now, that shouldn't matter because they're still in Hong Kong and they don't have any operations in the UK, except DAC6 does have a criterion. Its criteria for being EU are that you're incorporated there, resident there, place of management and control, or you're a permanent establishment operating there. But there's a fourth criterion, which says if you are a member of a professional organization in the fields of tax, accounting, or consulting, that too qualifies you as an EU intermediary, if you're actually an intermediary, as an EU person for purposes of DAC6. So if we hypothetically surmise that the Hong Kong one is a member of the UK bar, he or she would be a member of an EU-based professional association. Now, fortunately, that very broad concept, because it could cover, as it's stated, it could cover an enormous array of organizations and memberships with those organizations, has been gradually narrowed by several of the guidance notes that we've seen. And it seems like the prevailing view is, yes, membership in an organization counts, but it has to be the type of organization that controls your professional license and can strip you of that professional license or something along those lines. So therefore, being a member of STEP UK or STEP Germany does not qualify you as an EU intermediary, but being a member of the Bar Association probably would. So here now we've transformed the Hong Kong trustee into an EU intermediary. Now, at first, this would relieve the French relevant taxpayer of any reporting duty because there is an EU intermediary and therefore they have the primary responsibility to submit the report on this reportable cross-border arrangement. But because this Hong Kong trustee is a member of the UK bar, they have access to legal professional privilege. And legal professional privilege, more or less, depending upon which jurisdiction you're in, states that to the extent that the communications that would need to be reported under DAC6 would be subject to local attorney-client privilege standards, then you, as the legal party, are exempt from disclosing that information. You're not allowed to, even if you wanted to. The consequences of the trustee invoking legal professional privilege is that once again, we have no EU intermediary who is able or allowed to submit the reports. As someone just pointed out, the EU may not be the best example as it's no longer a member of, the UK may not be the best example if it's no longer a member of the EU. I'm not sure if DAC6 has expanded it to be, I think for the purposes, it would include the UK in there, but they could be a French lawyer otherwise, or a Cypriot lawyer. In any case, once the legal professional privilege standard is applicable, then the Hong Kong trustee has to notify all other intermediaries that there is a reportable arrangement, but they are not allowed to report on it. So those other intermediaries might need to take up the task, or, because it depends on the jurisdiction again, they need to notify the relevant taxpayers of the same. There is an arrangement, it's reportable under DAC6. There's no intermediary capable of reporting it, and therefore you have the responsibility because I have attorney-client privilege. Now, of course, the client can waive it. So the Hong Kong trustee might notify the French taxpayer, the French client, LPP, I can't do this report, and the French taxpayer would be like, I waive the LPP, I waive the privilege, submit the report. But you can see the mechanics of the reporting will change a lot where you have no EU nexus to the arrangement, or where the sole party with the EU nexus is going to be invoking legal professional privilege, can and will invoke legal professional privilege. Okay, so those are the concepts that we wanted to explore with scenario 1. Do we have any questions on this scenario or some of the analysis that we provided before we move on to example number 2? Okay, thank you. Okay, example number 2. So here we have the setup of fairly common private wealth management structure. We have a French owner of assets being held with a Swiss bank who arranges for a private wealth management structure to be set up, featuring a US administered trust on the top, a Cypriot limited holding company, underlying company, excuse me, below, holding European marketable securities at a Swiss bank, which were paid for by the assets transferred over, or funded by the assets transferred over from the individual account of the French client. And the beneficiary of this trust is a UK resident, presumed child of the French client. Okay, so as we move into the analysis of this scenario, we have the same question about whether it qualifies as a cross-border arrangement. Similar to scenario 1, the concerns aspect is met because we have these French and UK beneficiaries of this arrangement. What about the situation where you need the cross-border element? I mean, if we're talking about the financing of the holding company, we're talking about money going from one Swiss bank to another Swiss bank. So you could make the case here that it doesn't cross the border. There isn't a second country involved in that, and therefore the only participants, remember the active parties, the only active parties to the financing of the trust are both Swiss. Is that a good argument? It is, except it's very clear that when you do this analysis of the arrangement, you apply what we call step transaction concepts in the States, but it means you have to look at every single step in the arrangement, not just the specific step you'd like to. So here, when you're querying whether a hallmark is met or whether it's a cross-border arrangement, it's not just the financing of the asset holdings of the underlying company, but it's the setup of the trust, the setup of the underlying company, and the financing of the assets held by the trust through the underlying company that needs to be looked at. So it's the whole series or sequence of events that counts. And in this case, of course, you have US, Cyprus, and Switzerland all at play. So it's quite clear that it's going to qualify as a cross-border arrangement. Okay, now that we know it's a cross-border arrangement, let's think about whether it's going to be a reportable cross-border arrangement, which means it needs to meet one or more of the DAC6 hallmarks. And these four we're going to look at for this scenario. Again, this is your standard template hallmarks for the private wealth management industry. These should always be on your mind when you're looking at any arrangements. The first question is standardized documentation. So standardized documentation is a bit self-explanatory, but it means that the documents, the template can be reused without substantial customization to the specific circumstances of the client for whom it's being used. And as we've seen in some of the trust-friendly jurisdictions in their guidance notes, they limit this to really what are off-the-shelf arrangements. They want to narrow it down. So as long as you're making a few tweaks, twiddles, edits to the document, then that would no longer be standardized. But the less you do, the more likely it is standardized. And remember, those are the trust-friendly jurisdictions. So where you're looking at a non-trust-friendly jurisdiction, they're going to have a broader scope of what standardized can mean. In this particular scenario, we really have several options for what could be standardized documentation that would be relevant here. But the ones to focus on, of course, are the setting up of the trust, the trust deed. And mostly from what I've seen, most trust deeds are customized sufficiently to the client's demands. There's enough things you can put in or take out that you could say most sophisticated trustees, your trust deed will probably not meet this standard, depending upon which jurisdiction you're in. But of course, we're not only looking at the trust when we're talking about the setup. We're looking at the underlying company too. And likewise, in my experience, most underlying companies the documentation is pretty standardized. There's not a lot of modifications going on to the setup of underlying companies. And therefore, in most circumstances like this, you might not be captured on the trust end, but there's a very good chance you're going to be captured on the underlying company end. Now, the another common hallmark, B2, is income conversion. And income conversion means basically finding a way to convert streams of income from one characterization that's taxed at a higher level to a second characterization that's taxed at a lower level. And classic examples of this would be any way that you can stick receivables, other types of standard come into a vehicle you can then sell, have gross proceeds from. And typically gross proceeds, capital gains, as we call them in the States, are taxed at a lower rate than ordinary income, dividends, and such. Now, in this scenario, moving these assets under a trust structure, that certainly does give options for income conversion. Now, there's different ways. It might be that the dividends will be taxed differently because there'll be dividends coming from a closely held company rather than through publicly traded companies. It could be that you dissolve the underlying company at some point, and some of the accumulated earnings in that underlying company will be taxed at gross proceeds rates rather than the standard dividends rates, if you had taken them out some other way. Or you could even sell the underlying company, maybe not the most likely circumstance, but you could sell it, and then it would all be gross proceeds, not necessarily the normal earnings and dividends and earnings. But the question here that we have that we are struggling with is, do you know this at the start? And if you don't, does it make it reportable? So going into this setup, you might deliberately be doing it because you know there's a tax benefit to the way you'll take out the income through this structure. Or you might be doing it because there's a potential tax benefit that you think you might want to use, but you're not committed to it yet. Or you might not be aware of the tax benefits from income conversion that you'll get out of this structure, but down the line, you might become aware of it and take advantage of it. So at what point, and this is not clear from the guidance, this is an open question, at what point does it become reportable under DAC6, or what point does it meet this particular hallmark under DAC6? When you set up something that has the future potential to convert the income, or when the income is actually converted? We don't know. That's probably a decision that we hope some of the regulators will help clarify. But if not, we'll have to come to our own conclusions based on risk appetite. Now, before we move on to the D hallmarks, we need to talk about the main benefit test. For both Hallmark A3, the standardized documentation, and Hallmark B2, income conversion, both of these hallmarks are also subject to the main benefit test, which queries whether the tax advantage obtained through the arrangement was one of the primary reasons for entering into the arrangement. As stated in the statute, as discussed in a webinar back in November or December that focused almost entirely on the main benefit test, it's an incredibly broad concept, especially as it applies an objective standard of a third-party reasonable person looking at the arrangement. Meaning that even if your actual intent was not tax-driven, if an outsider would look at that and think, yeah, that was tax-driven, then it meets the main benefit test. Certain jurisdictions have narrowed down the statutory scope of the main benefit test. Some argue that if it's consistent with the principles of existing domestic tax legislation, then the main benefit test isn't met. Others query whether would you go ahead with the structure in exactly the same way if you lost the tax benefit, and still others might make a combination of those two, or try and formulate a situation in which you calculate the amount of the main benefit and you compare that to the economic benefits of the arrangement itself, and then you determine based upon, is that percentage meaningful enough to be one of the main benefits, main drivers of the arrangement. So there's fragmentation across the EU member states on this point. And, as talked about during the webinar focused on MBT, none of them are entirely satisfying. They all have their pros and cons, and we'll have to see how they evolve and develop over the course of DAC6. In this scenario, I mean, it's very difficult to argue that setting something up like this isn't driven by tax reasons. It would probably not pass the smell test, the laugh test, whatever you want to call that. But at a minimum, you've got some deferral benefits. You've probably got some, if we're meeting the income conversion test, then you've definitely got some reduction in tax rate benefits that you're looking at here. And once you start having these concrete tax benefits, with no, I can't even say with no alternative, because a reasonable outside person will just look at those tax benefits accruing to you from this structure and say, sure, then therefore tax must have been one of the drivers, especially in an offshore situation. So while the main benefit test may disqualify many, in fact, arrangements that meet certain ones of these hallmarks, in this setup, I don't really see the main benefit test rescuing anyone. Okay, so those are the first two hallmarks, standard fiduciary hallmarks. The next two are the D hallmarks. So CRS avoidance arrangements and opaque offshore structures. So CRS avoidance arrangements are arrangements that have the effect of undermining the local CRS legislation. Now here, if we start with the first scenario where the money's held in the Swiss bank for in the individual account of the French client, we know that for CRS purposes, that there's a report being issued annually by the Swiss bank to the French authorities or to the Swiss authorities, and then on to the French authorities, detailing the contents of this account and the identity of the account holder. Okay, now what happens when we move the money over underneath the company, underneath the underlying company? Well, first and foremost, the Swiss bank is no longer doing any of the reporting, because the account holder is a reporting FI based in a partner jurisdiction, Cyprus, and therefore the FI status of the underlying company is respected by the bank. So the bank's not doing the reporting. The report's not coming from Switzerland. Probably that alone has no bearing on whether it's a CRS avoidance arrangement, because the Cypriot company has a similar network of reporting arrangements as does Switzerland, as Switzerland's. France is part of that. And so the Cypriot company, as a reporting FI, will be doing a report. And because the trust is US and therefore looked through, not respected as an FI, the Cypriot company will be doing a report on the controlling persons of the trust. Now, the controlling persons of this trust are the UK beneficiary, but it's also the French settlor of the trust. And because settlors are reported with all of the assets held by the trust, the Cypriot company is actually reporting the exact same information on the French settlor as the Swiss bank was prior to this transaction. Now that's by design. That's how this illustrative example is set up. Could of course be a different way. It could be where the ultimate report does not cover the settlor or does not cover all of the assets held through the trust. And then of course you really have to query whether that qualifies as a CRS avoidance arrangement. Initially, I would have been certain that it did, that the rule was so strict under the OECD MDRs. A colleague of mine, Peter Cortacciano, and I, we wrote an article for Trust and Trustees back in 2018, in which we argued that this would result in an enormous amount of needless reporting. But since then, we've seen certain jurisdictions try and reduce the consequences and inject a subjectivity standard that really asks whether the purpose of the arrangement was to avert CRS reporting. And so even in situations where maybe the French settlor was no longer being reported to the full extent of the assets, there could be plenty of arguments available that didn't drive this arrangement. He or she was trying to set up a structure for the benefit of their child or family member in the UK. Now, so in general, CRS avoidance arrangements probably not applicable here, and less applicable in these situations than what I initially imagined, but still something that must be, of course, contemplated and analyzed before it can be discarded. Now, the final potential hallmark is the opaque offshore structures. And there's multiple parts to that test. If you have a nominee shareholder, that would definitely qualify you as one. If you're operating out of a jurisdiction that appears on a blacklist, that could qualify you as one. But what they're really going to be focused on here is that whether somehow the US, in this particular example, the US trustee is obscuring the identities of the real beneficial owners of these assets. No, I mean, at the current moment, no one's listing the US as an opaque offshore jurisdiction. But I think a question that's been bubbling around for a while is the US coming to a blacklist near you? It's generally accepted the US is the largest tax haven in the world at this point. And we're starting to see a lot more agitation against the US based on double standards it applies to other countries for their tax transparency rules. Recently, the very end of the prior administration, there was a defense appropriations bill that included a beefed up anti-money laundering provision. And we will see whether that settles some people. It's definitely not the level of transparency that the US demands from other countries, but it's a great deal more transparency than the US has had the potential to provide before. So that may develop into the US providing sufficient transparency that they never have to worry about being on an opaque jurisdiction blacklist. If not, or if there's a retrenchment in the US against transparency, one could imagine that countries will band together, gang up on the US and use this leverage in order to get better, fair responses from the US. But currently, you're not going to see in the US, Cyprus is an EU country, and the US is not yet on any EU blacklist. And there's nothing additional about this example, such as a nominee shareholder, that would make one think it would qualify as an opaque offshore structure. So at the end of the day, I would say it's probably not an opaque offshore structure. I myself, I don't identify any other hallmarks that would be potential here, at least on the surface. One thing we're going to talk about at the next scenario is many of these hallmarks can be lurking beneath the surface. But in terms of your standard fiduciary hallmarks, it would seem to me that the standardized documentation will likely be met with the underlying company. That can be changed, but based on my experience, that would need to be changed to avoid that hallmark. And on income conversion. And that it will meet the main benefit test, and therefore it will be a reportable cross-border arrangement. Now here we have multiple intermediaries. We have the Swiss banks could qualify if they provided any advice, played an advisory role with respect to this setup. And certainly the US trustee almost surely played a sufficient role to become an intermediary, and probably likely the Cypriot corporate directors would be tagged with an intermediary role. Out of all of these intermediaries, only the Cypriot corporate directors are EU based, and therefore we would expect the reporting to be done by the Cypriot company. Now, when is it going to be due? Well, it's weird, right? I mean, it's a 30-day timeline, but that 30 days is determined by the activity, not the setup of the structure or the financing of the trust necessarily, but by the relevant service provided by the reporting intermediary. So in this circumstance, we have the Cypriot directors being the reporting intermediary. And when did they first provide the relevant services of setting up the structure? I mean, God, it could be ages prior to the actual funding of the trust. It could be the day before the funding of the trust. So the deadline for reporting will not always be consistently tied to the main activity of the arrangement. It may well, depending upon which party is doing the reporting, actually be connected to what you would consider an ancillary component, no offense to underlying companies, an ancillary component of the structure. Always worth keeping in mind as well, because most people will be focused, of course, on when the money was transferred, right? Because that's the big shot. But that might not be what causes the 30-day clock to start ticking. And then marketable arrangements. Now, marketable arrangements are best understood as using the same documentation over and over and over again, and you qualify as a promoter rather than a service provider type of intermediary. That's how I would like to think of them. I think that there makes the most sense. Unfortunately, the text doesn't always back me up. And in fact, a marketable arrangement is what I just said minus the promoter aspect, meaning a marketable arrangement and the use of standardized documentation, there's a lot of overlap between those two. But there's certainly been no explicit statement anywhere that hallmark A3 necessarily leads to a marketable arrangement. So we have to assume that there's something stricter about the definition of a marketable arrangement. And for me, the best way to understand it is that you take the standardized documentation and you go out and you try and sell it to your clients, as opposed to your clients coming to you and asking for support. Otherwise, there's not a ton of daylight between the marketable arrangement and the standardized documentation. The downside of a marketable arrangement is not only do you need to nominate it as such, but you need to do serial reporting. Usually under DAC6, it's a one-off report and you're done. But if it qualifies as a marketable arrangement, you need to do serial reporting throughout the life of the arrangement. And no one wants to keep doing that. So we are working towards and hoping that we'll get more guidance on when it might qualify as a standardized documentation, reportable arrangement, but won't necessarily be a marketable arrangement. Okay, I have another question here. Does a shift to opaque treatment created by the death of a settlor or UBO create a reporting obligation after the setup? I don't think so. I don't know, John, if you could, do you mean under the CRS avoidance arrangement or under the opaque offshore structure? I think you're talking about the CRS avoidance arrangement, but if you're still there, if you could clarify. Because once the French settler client dies, then the fact that he's no longer or she's no longer being reported for CRS is irrelevant. That's not because of the setup, that's because of the demise. And I don't think the US trust remains look through for CRS purposes, even following the death of the settler. There's no grantor complex trust shift here. So I'll wait for John to maybe elaborate on that, and I'll move forward and come back to it. No? Okay. Okay. Any other questions on illustrative example number 2 before we move on to our third and final example? Okay. So here we have a Swiss single family office with Anglo-French family principles, and the family office has multiple operations in multiple jurisdictions. On the far left, you see we have a treasury center based in Switzerland. Then we have an investment center just set up in the Cayman Islands to look into private equity funds. Then we have a private equity fund operation, which functions like a fund of funds just for the single family office. Then we have a holding company in Switzerland, which holds a portfolio of marketable securities. Then we have a holding company in the UK, which holds some lovely Mayfair property and other UK real estate. And then at the far right, we have the family business, the French family business of factories and imports and exports and other non-financial asset stuff. We have 4 separate transactions. First, the Treasury Center transfers some jobs to the investment center. So in my head, the narrative is that this single family office has decided to go heavily increase their investments in private equity funds that are based in Cayman and typically investing into the US. So rather than have everything located in Switzerland, they've moved a bunch of activities, jobs and such over to an operation they set up in the Cayman Islands. Transaction number 2 is a loan from the Treasury Center to the private equity fund of funds setup they have to actually get the ball rolling on the investments. Then number 3, once they've made some money on their private equity investments, they send some off to other operations. Transaction 3 is a loan from the private equity funds to the real estate hold company, and number 4 is to the portfolio holding company. So I think loan number 3 is to the portfolio holding company, and loan number 4 is to the real estate holdco. It's confused in the scenario summary. Now, the first topic we're going to look at here is associated enterprises, because Hallmarks C and Hallmarks E, they talk about transactions between related parties, which are known as associated enterprises under DAC6. And an associated enterprise is any entity over which the relevant taxpayer, and the relevant taxpayers here would be the Anglo-French family, is in a position to exercise a significant influence and or of which the relevant taxpayer owns 25% or more of the intermediary directly or indirectly by vote or value, capital, or profits for corporations, partnerships, respectively. So this is very similar to related parties. It's intra-group companies. So these are all These hallmarks are designed to identify basically a consolidated balance sheet where you can make a profit by having two entities that you own, one of which loses money on the deal, but the other one makes more money than the first one loses, and therefore for the owner, it's net profitable. And that's what these, and I'll explain a little bit more in detail how that works when we get to the actual transactions, but that's the concept that they're looking to avoid or to force disclosure on. So the first transaction, there's no assets being moved. There's no sale of anything. No one's transferred over money or any securities or anything like that. It's just been a reassignment of jobs, a cross-border reassignment of jobs. And this is a very interesting hallmark for just that reason, is you don't even really see the transaction or the arrangement at play. But it does qualify. A shift of functions will qualify to the extent it involves an intragroup. So an intragroup related party, they're synonymous. Cross-border transfer of functions and or risks and or assets. And then there's this question about if the projected earnings before interest and taxes, so EBIT, during the 3-year period after the transfer or the transferor or transferors are less than 50% of the projected annual EBIT of such transferor if the transfer had not been made. By far the longest hallmark in its description, mainly because of this EBIT caveat to it. And each single arrangement, you'll need to do the calculations on the EBIT or the projected EBIT for the transaction. But what you really want to be cognizant of is things like where jobs move or somehow risk is moved or assets are moved into a group and cross-border, that all of a sudden you have to start looking at the transfer pricing function. We don't really think of transfer pricing as a private wealth management tax issue, but it certainly will come into play for DAC6. So here, I haven't made up any of the EBIT numbers for this example, but at least the first part of Hallmark E3, where the functions and potentially the risk is transferred cross-border intergroup from the Treasury Center in Switzerland to the Investment Center in Cayman, the first part of that hallmark is quite squarely met. No concept if the EBIT will be met, but that will be determined in real time, real life. Okay, so that's number one, and that looks very, very clearly like that would be reportable. And there's no main benefit test on the transfer pricing hallmark. So once you meet the hallmark, the first part of the hallmark, then it's a reportable cross-border arrangement. Okay, let's look at number 2. And in number 2, we've got a loan going from Switzerland to Cayman, both companies intergroup, and this looks like it could meet one of the C hallmarks that talks about where you're going to have payments that are going to be subject by one of the parties to a 0% or near 0% tax rate. Cayman's famous for having such a tidy tax rate, or to payments where where one of the parties has no tax residence. Now, the idea here is if you make a loan from one jurisdiction with a low tax rate to a sister corporation with a high tax rate, then what happens is the one in the high tax rate makes interest payments, and those interest payments are deductible at a higher rate because of the higher tax rate there, versus the income that needs to be reported, acknowledged by the recipient of the interest payments, so the creditor. Those are taxed at a very low rate, meaning that in total, the consolidated effect of this is that you can get an advantage on the reduction in tax rate on the interest payments versus the deduction you get in the high jurisdiction pays for the taxes you have to pay in the low rate jurisdiction. So in a situation where you have Switzerland, not a high tax rate jurisdiction, but a moderate one, and Cayman, a very low 0% tax rate jurisdiction, you have all of the ingredients for this hallmark. But if you've been listening to what I've been saying about the purpose of this, it's going the wrong way. in this case, all of these deductible payments are coming from Switzerland to Cayman. All the deductible payments are going from Cayman to Switzerland. And therefore, the Swiss Treasury Center has to report and pay taxes on the interest income it receives. That's bad because that's at a higher rate than the Cayman company pays. And the Cayman company gets tax deductions on the interest payment it makes, but that's also bad because there's no point in having tax deductions in a tax-free 0% corporate tax jurisdiction. So here, number 2 would not qualify for either of these hallmarks. In addition, you could also bring in the fact that these private equity funds are probably not tax resident anywhere if they're simple partnerships, but it's irrelevant because the payments are going in the wrong direction. However, in example 3, the payments are going in the right direction. The loan is going from Cayman to Switzerland, meaning Switzerland, the Swiss company is making interest payments to the Cayman company, and the Swiss company is deducting those interest payments at the Swiss tax rate, and the Cayman company is receiving those interest payments at the Cayman 0% tax rate. Now, one question that we would have here, that we are also bandying about internally, is the hallmark talks about a deductible payment. That is, the payment is the trigger for the analysis of whether the hallmark is met. Could you, though, take a position that where you have a series of set payments, you know the payment table, so a loan where you would have a 10-year loan and annual interest payments, could you, rather than report every year on that interest payment received by the associated enterprise, could you report a single time for the loan agreement? And could you calculate over 10 years, we'll make this much in interest payments, net present value back to today, and that's the value of this loan agreement? That would certainly provide the regulators the information they're looking for, while also saving everyone involved, the regulators and the regulated parties, the exhaustion of having to do 10 reports as opposed to 1. Still haven't seen guidance that says that's okay, and as currently written, it talks about deductible payments rather than contracts with deductible payments or arrangements with deductible payments. But we're hoping to find a way to streamline the reporting process to the actual agreement versus the payments for the agreement. And okay, and now we have example number 4, which is a loan going from Cayman to this UK real estate holdco. Now, on the surface, it looks exactly like number 3, right? There's no difference. The interest game is being played, consolidated interest game is being played between a higher tax jurisdiction, this being the UK, and a 0% tax jurisdiction or non-tax resident entity in Cayman. But here's the tricky bit. So here you would say the 2 intermediaries would be the fund, the Cayman fund, and the holdco in the UK. Okay, the only EU intermediary in that setup is the UK holdco. However, as you guys may know, many of you I'm sure know, the UK sharply curtailed its DAC6 commitments at the end of last year, eliminating all of the hallmarks except for the 2 OECD MDR hallmarks, so the D hallmarks, the CRS avoidance arrangements and the opaque offshore structures. Meaning, even though this arrangement satisfies hallmarks C, C1A, C1B little I possibly, that does not make it a reportable cross-border arrangement for a UK intermediary. So if you look a little bit further up, you can imagine that the Swiss trustees may also have played a role, or the Swiss Treasury Center, if that's where their tax and investment experts, general tax and investment experts sit. But unfortunately, you're still looking at no EU intermediaries in this arrangement. And in the absence of EU intermediaries, as discussed at the onset, the reporting consequences will fall on the relevant taxpayers. And as only one relevant taxpayer is in a jurisdiction that treats these types of payments as reportable under DAC6, that being the French person, it seems like that would be the one relevant taxpayer who would get burdened with the DAC6 reporting on this arrangement. At least that's our analysis of the situation, that it would fall to the family. Now, that covers the four transactions I wanted to cover and these more exotic types of hallmarks. One thing we didn't bring into this scenario is the family business. We put it there on the far right to keep it in everyone's mind, but it's a bit of a red herring in terms of the actual illustrative example we're providing here. But as you can imagine, many of these situations where the hallmarks are met will involve somehow the family business making intercompany loans, etc. Because as long as that family business is vertically integrated, and you can ascribe 25% or more ownership to the Anglo-French family, or perhaps to maybe to the holding company, depends how you where you want to set the calculation. All of those transactions, intercorporate transactions, are potentially reportable by the private wealth management structure. As we've developed our thoughts around this, we decided that was a significant enough topic as a standalone proposition that our next thematic webinar, which will take place in March, presumably, we're going to focus on what we call the corporate hallmarks can mean, both in the corporate sphere and also in the private wealth management sphere. So for purposes of today, the family business is just a red herring, but please pay attention to your inboxes, because we'll be coming out with another webinar in a couple weeks' time, which will delve into how these hallmarks, the interplay of these hallmarks and family businesses and the private wealth management sphere. Okay, that covers illustrative example number 3, which was our final example. I think I have one question, but we're actually moving on to the Q&A session now. So please, any questions you may have, please send them in. So the question here is, what if the loan interest percentage charged by the private equity fund is lower than the market rate? Is there still a tax advantage for the real estate holdco? Yes, there's no focus in this statute or any of the guidance I've seen that talks about that the rate needs to be fair market value or anything like that. As long as there is an interest payment made or deemed to be made, of course, in certain circumstances, they'll treat you as if you made an interest payment for tax reasons. OID for those US tax people out there. Then that payment alone is what's going to trigger the analysis and the potential reporting in this scenario. So yes, would be my answer to that question. Yes. And yes, that there's definitely still a tax advantage there, because you're, for the mother company, the owner of the subsidiaries, who overall is making money off the deal due to the differentials in tax rates. Okay, so that's the last question I have in the queue. Sorry, I've gone over time again, but if anyone has any final questions, I'm happy to field them before I bid you all farewell. That question will be stricken from the record. Will Duke make the NCAA tournament? Yes, we will, and Chelsea will win the Champions League. Thank you all for joining us today. Please stay safe, and we look forward to seeing you at our next webinar in a couple weeks' time. Thank you very much. Bye-bye.